December 10th is fast approaching, and you might be asking yourself, Mark, what's going on December 10th? Well, December 10th is when the next Fed decision on interest rates are expected to take place, and right now there's a near 80% chance that the Fed is going to once again cut interest rates by another 25 basis points on that date, which is down from 92% just a month ago. For me, I've talked a lot lately about the Fed not needing to really cut interest rates based on the economy right now, but when you turn your attention to the labor force, it's looking like it needs to happen. And for the Fed, they have a dual mandate: maintain monetary policy to keep things from getting too heated in terms of inflation, and the second being to maintain full employment. And we will talk about this more in today's video, how an interest rate cut could again fuel the stock market to a new all-time high. And in today's video specifically, we're going to be talking about 5 stocks that you want to have in your portfolio before that rate decision comes on December 10th. So make sure you stay tuned throughout the entirety of today's video. It's going to be a good one. I know you're going to enjoy it. And before we jump into it, show your appreciation for these videos by just simply clicking that like button down below. I appreciate it. Really helps with the growth of the channel. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into today's video talking about 5 stocks we want to own before December 10th. And before we do, let's talk about why do I believe a rate cut is going to be bullish, at least in the near term, for stocks, on why they could reach a new all-time high. Again, we've been going through this period where rates have been quite high. And sure, the hyperscalers have done a lot of spending, but higher rates lead to higher borrowing costs. As those rates come down, it's going to allow a lot more companies to get involved with a lot of this CapEx that's been going on, specifically within technology. So with that being said, let's jump into the 5 stocks I'm looking to own in my portfolio before December 10th. And the first one's going to be a no-brainer. That one's going to be NVIDIA, stock ticker NVDA. NVIDIA is at the center of this AI craze that we've been going through. And just recently, the company reported its latest earnings results that beat on both the top and bottom lines. And on top of that, they issued guidance that blew away expectations. However, surprisingly, the stock still fell. And for that, I viewed it as a buying opportunity. So what did I do? Exactly what I just said. I went in and bought more, added to my position, something I let all of my Edge Plus subscribers know within my Discord community, the Stock Investors Edge. And again, if you're not yet part of that community and want to see my entire portfolio, get trade alerts anytime I buy or sell a stock, we also have our options focused subscription as well. Right now, through the end of November, we have our Black Friday sale that's going on, our biggest sale of the year, and you can check out that link down in the description below. Getting back to NVIDIA though, the company currently has a market cap of $4.3 trillion with a T, making it the largest company in the S&P 500. Their enterprise value is also $4.3 trillion. And I like to look at enterprise value because it brings into account debt and cash. Over the past 12 months, shares of NVIDIA are up roughly 35%. The thing you have to ask yourself about NVIDIA is, can they continue to dominate? Are they continuing to dominate? Or is competition starting to take some market share? And the answer to that is, sure, competition is growing, but when we look at the financials, we look at the backlog, we look at gross margins, this company is still on fire. Looking here at Fiscal AI, we can see that revenues are nearing $200 billion. But more importantly, we see margins remain extremely high. Gross margins at 70%, operating margins nearing 60%. If competition were close to NVIDIA, they would have the ability to eat into those huge margins, and it's just simply not the case. In fact, when you look at this chart, I broke out the results by quarter, and you can see margins have actually been expanding in back-to-back quarters. Taking a look now at valuation, this is still not a stock that's overpriced. The PE sits below 30 at 26.3 times, and the EV to EBITDA is currently at 38.9 times. When people talk about an AI bubble, Cisco had a PE over 200 times at the point in time of the dot-com crash. When it comes to earnings, they're expected to grow at an average rate of 43% over the next 2 years, giving the stock a PEG ratio of just 0.6, which is incredibly cheap. The multiple you're paying for the growth expected is showing you you're getting phenomenal value. And this is a stock that wants over $200 again in the near term, and analysts believe it's going over $250 over the course of the next 12 months, as they have an average price target of $257, implying roughly 40% upside from current levels. And that leads us to stock number 2, which is going to be Advanced Micro Devices, stock ticker AMD. And we talked about competition when it comes to NVIDIA. And I would say one of the closest competitors is going to be AMD. But there's still a wide gap. But that's also the exciting thing about AMD, is we don't need AMD to surpass NVIDIA for it to be a successful investment. If they were just able to close the gap a little bit, that could provide huge shareholder returns. The company currently has a market cap of $332 billion. Just right there, you can see just the sheer size difference between them and the $4 trillion NVIDIA. In terms of enterprise value, that's at $328, so it's actually lower than the market cap, telling me that this is a company that has more cash on hand than debt. And over the past 12 months, shares are up over 50%. So far in 2025 and over the course of the past 12 months, AMD shares have actually outperformed that of NVIDIA. And a lot of credit has to go to CEO Lisa Su on how she has guided this company and brought a resurgence feel to AMD. When looking at the financials here on Fiscal AI, you could see top-line revenue growth from AMD has been solid, with strong margins also at 48.3%. Now you might think, yeah, those are good, but they're much lower than the 70% we saw with NVIDIA. And that's where the difference lies. NVIDIA dominates the higher margin data center space. AMD dominates more in the PC world, but that's lower margins. NVIDIA dominates in gaming, higher margins. AMD more in custom chips, can be lower margins. Looking here at valuation, with the stock having a strong move higher, the PE on a forward basis is actually higher than that of NVIDIA, which again speaks to just how cheap NVIDIA is. But currently with AMD, the forward PE is 38.7, the 5-year average is 33.4, and at one point this year, the PE actually dropped all the way down below 20 briefly. Earnings, though, are expected to grow at an average rate of 60% over the next 2 years, giving the stock a PEG ratio of just 0.6, which is, again, incredibly cheap and also in line with that of NVIDIA. The multiple you're paying compared to the growth expected is showing you are getting phenomenal value. And this is a stock that will again be above $250, in my opinion, sooner rather than later. And analysts agree as they rate the stock a strong buy, giving it a 12-month average price target of $285 per share, implying nearly 35% upside from current levels. And that leads us to stock number 3, which is going to be Amazon, stock ticker AMZN. And again, if you're part of my community, the Stock Investor's Edge, you know how much I love Amazon, one of my favorite stocks on the entire market. And you know that I was pounding the table when shares were at 160 and jumped up to 200. And then you saw shares go from 220 back down to 200. And yet again, I was pounding the table, buying more. And what happened after the company recently reported earnings? Shares surged up to $250. But from there, they already reduced another 10%, giving us another opportunity to accumulate more shares. When it comes to Amazon, they currently have a market cap and enterprise value of both $2.4 trillion. So again, another company with not much of a debt issue. And over the past 12 months, shares of Amazon are up 12%. Now again, not a stock that's going to knock your socks off in terms of performance. 12%, you're like, okay, that's good and all. But this is a company that we get perfect clues on of when to buy when it's cheap. Let valuation guide a lot of your purchases and even sales. And if you look at this particular company, from trough to peak, shares of Amazon just this year alone have climbed more than 60%. And when it comes to Amazon, it's a diversified company. Of course, they're the largest e-commerce player, but they also happen to be the largest in cloud, with AWS dominating that particular sector. They're also a top 3 advertiser. They're investing heavily into AI and robotics, 2 huge areas of the future. And when we take a look at this Fiscal AI chart, we can see a breakdown of the company's segment revenues. E-commerce sales dominate, followed by third-party seller revenues. There's AWS revenues coming in third, and then advertising. And again, this is a company that does not get enough credit for being a top 3 advertiser by revenue. And another area that I didn't mention was Amazon, also very much similar to that of Alphabet's Waymo, has their own self-driving, call it robo-taxi, with Zoox. Looking here at valuation, we can see that Amazon has an EV to EBITDA, which is one of my favorite metrics to look at for this stock. We can see it currently trading at just 17.8 times, compared to a 5-year average of 22.9 times. The company is simply not getting enough credit for the EBITDA they're generating. And as you can see from this chart, EBITDA continues to skyrocket higher. Analysts rate the stock a strong buy with an average 12-month price target of $300, implying more than 30% upside from current levels. And that leads us to stock number 4, which is going to be Mercado Libre, stock ticker MELI. And we just talked about Amazon, and this is a much, much smaller version of Amazon, but it gives you more of that international presence, as Mercado Libre dominates more in the South America region. When it comes to Mercado Libre, they currently have a market cap of $99 billion. Again, much smaller than that of Amazon. And they have an enterprise value of $105 billion. So again, not a huge debt issue by any means, but they do have more debt than cash on hand. And over the past 12 months, shares of MELI are down 4%. Now, when you look at the chart, shares of MELI have been caught in a downward trend, erasing all 2025 gains and 12-month gains, down nearly 30% from their recent highs made at the start of July of this year. Now, when it comes to Mercado Libre, again, a much smaller size of Amazon, so still young, but that also leads to the excitement as a shareholder as they continue to expand their footprint, and this shows in the financial results. Looking here at Fiscal AI, you can see how revenues have absolutely exploded in the past few years. But on top of that, they're also operating with strong gross margins above 50% and double-digit operating margins, which I love to see. Looking here at valuation, shares traded an EV to EBITDA of 27 times, well below their 5-year average of 40 times, but also higher than that of Amazon. And on a forward PE multiple, shares trade at 39.3 times, well above their 5-year average of 60 times. When it comes to analysts, they're looking for strong earnings growth the next few years, as they have a 2-year EPS growth rate of 45%, giving the stock a PEG ratio of only 0.86, again suggesting that what you're paying for compared to the growth that's expected, you're getting great value. Analysts also rate the stock a strong buy with an average 12-month price target of nearly $2,800 per share, implying nearly 40% upside from current levels. And that leads us to stock number 5, which is going to be Realty Income, stock ticker O. And Realty Income is one of the most well-known REITs or real estate investment trusts on the market today. And if you're looking for a high growth machine like the first 4 stocks we've looked at, then Realty Income isn't going to be the name for you. However, if you're looking for real estate exposure, a very high dividend yield, and upside potential, Realty Income is going to be a great pick. The company currently has a market cap of $52 billion. However, over the past 12 months, shares haven't really gone anywhere as they're down just 1%. Now, REITs in general have been a poor performing sector for a few years now, and that has a lot to do with those high interest rates we've been dealing with over the past few years. The real estate sector in general is a very interest rate sensitive sector. Looking here at this Fiscal AI chart, you can see that in a 3-year period in which the S&P 500 grew 66%, you can see IYR, which is a popular real estate ETF, grew just 8% over that period, and Realty Income fell 13%, lagging badly, not only its sector, but the S&P 500. But the company has tremendous assets, and they have a great management team leading the way. And when you look at the financial results, regardless of what's going on in the economy, regardless of where interest rates are, the company continues to perform better and better results. And what do we know is on the horizon? Lower interest rates. Looking at this chart here, you can see how Realty Income has proven to be a compounder of wealth as revenues continue to rise, and more importantly, FFO, or funds from operation, also continue to rise over the years. And because of that, the company is able to pay out a juicy dividend that currently sits near 6% and has been growing for more than 30 consecutive years. From a valuation perspective, we don't look at EPS when it comes to REITs. Instead, we focus on AFFO. And over the past decade, shares of O have traded at a forward price to AFFO of 16.5 times. But today, you can grab shares for just 12.8, making it one of the cheapest in the stock's history. And when it comes to analysts, they rate the stock a moderate buy with an average 12-month price target of nearly $63 per share, implying 11% upside in the stock price. but that also go along with a 6% dividend yield. You need to look at the total return. So there we just looked at 5 very different companies. The first 4 had much higher growth than the REIT one, but with interest rates coming down, that's going to be a huge benefit and tailwind for the REIT sector as a whole. Down in the comments section, again, let me know which of these 5 stocks is your favorite, and also make sure you head down there to the description and see that we have that 30% Black Friday sale going on for my newsletter right now, The Stock Investor's Edge. Thanks again for watching, and if you haven't done so yet, please smash that like button, subscribe to the channel, and we'll see you in the next one. Take care.